You've probably seen the headlines by now. London is running out of silver, vaults are empty, lease rates are exploding. Some channels are framing this as an imminent breakdown of the physical market, others as the spark for a silver price shock that's supposedly already underway. If you've been watching precious metals for any length of time, you know this is exactly the kind of moment where clarity matters more than conviction. Today, I want to slow this down, strip away the hype, and walk through what the data actually says, what it doesn't say, and how I'm positioning around it. This is Financial Briefing, and the goal here is not to scare you or excite you, but to help you think clearly when the noise is loud. Before we get into the numbers, I want to start with accountability. Earlier this year, in late January, I said silver between $22 and $24 was undervalued relative to gold and industrial demand, but I also said I did not expect an immediate breakout. What happened was a slow grind higher into the high 20s before momentum picked up. In April, we discussed the gold breakout above 2,300, and I warned that silver would likely lag initially. That played out almost exactly, with silver following several weeks later. And more recently, in early June, I said lease rate spikes alone were not enough to confirm a supply crisis, and that inventory data would matter more. That's the lens we're using again today. I get things wrong sometimes, and when I do, I'll say it, but the process stays consistent. Let's talk data. The first and most cited data point right now is London Silver Vault inventory. According to publicly available clearing and vault data, silver holdings in London are down roughly 15 to 18% from their peak levels 2 years ago. In absolute terms, we're talking about inventories falling from around 1.1 billion ounces to somewhere in the 900 million ounce range. Historically, that matters because London is the backbone of the OTC silver market. It's where large institutional trades clear, where ETFs source metal, and where leasing activity is concentrated. Compared to the last decade, current inventories are at the lower end of the range, but they are not unprecedented. We saw similar levels in 2016 and again briefly in 2020. What this means is that the buffer is thinner. It means disruptions have less margin for error. What it does not mean is that London is literally out of silver or that contracts are about to fail en masse. The metal still exists. It's just less freely available at current prices. The second data point getting attention is silver lease rates. Over the past several weeks, short-term lease rates in London have spiked from near zero to roughly 4 to 6% annualized, with some very short-dated tenors printing even higher. Context matters here. Lease rates reflect the cost of borrowing physical silver, not a directional price bet. Historically, lease rate spikes often coincide with temporary mismatches between immediate physical demand and available inventory. In 2011, lease rates spiked briefly during the run-up to $50. In 2020, they spiked during COVID-related logistical disruptions even as prices fell initially. What this means is that there is stress in the physical lending market right now. Someone wants silver today and is willing to pay up for it. What it does not mean is that the price of silver must explode. Lease rates can normalize without price following if supply responds or demand eases. The third data point is ETF flows, particularly out of London-backed silver ETFs. Over the last 12 months, we've seen net outflows of roughly 120 million ounces from major silver ETFs. Historically, ETF flows tend to reflect Western investor sentiment rather than industrial demand. When prices rise, ETFs often see inflows. When prices stagnate, metal gets redeemed and shipped elsewhere. What this means is that silver is moving from passive investment vehicles into other uses or jurisdictions, potentially including Asia or industrial channels. What it does not mean is that global silver supply is collapsing. It may simply mean that ownership is changing hands. So let's talk about the bullish case, calmly. 1. Industrial demand continues to surprise to the upside. Solar, electrification, and data infrastructure are using more silver per unit than many forecasts assumed 5 years ago. 2. If lease rates stay elevated, it discourages short selling and increases the cost of maintaining large paper positions. 3. Gold, holding above 2,300 supports silver on a relative basis, especially if the gold-silver ratio continues to compress from the mid-80s toward the 70s. And 4. Inventories declining, slowly but steadily reduce the system's shock absorbers. Put together, there is a plausible bullish scenario where silver moves into the mid to high 30s over the next 6 to 12 months. I assign that outcome about a 25% probability. Now the bear case. 1. Higher prices incentivize supply response. Scrap flows increase quickly when silver moves above $30. 2. Industrial demand is not immune to economic slowdown. A soft landing is not guaranteed. 3. Lease rate spikes have a history of fading quietly once metal is mobilized from less visible sources. And 4. Speculative positioning in futures markets has already rebuilt significantly, meaning some of the easy upside may be priced in. In this scenario, silver struggles to hold above 30 and drifts back into the mid to high 20s. I give that about a 30% probability. The middle case is where I'm anchored. Physical tightness remains, but it doesn't break the system. Lease rates ease but stay above zero. Silver trades in a wide range, roughly $28 to $35, with volatility but no runaway move. Over time, fundamentals improve, but price advances are incremental rather than explosive. That's a 45% probability in my view, and it's the scenario I'm positioned for. For historical context, the closest parallel is probably 2010 to 2011. Back then, inventories were declining, lease rates spiked, and silver ran hard. The similarity is physical stress combined with investor interest. The difference is leverage. In 2011, retail leverage and speculative excess were extreme. Today, leverage is more constrained and regulation is tighter. That reduces both upside blow-off risk and downside crash risk. Looking across markets, gold is holding firm above its breakout zone, which is constructive. The dollar index is range-bound between 104 and 106, not collapsing, but not surging either. The 10-year yield is elevated but stable. Together, this suggests a macro backdrop that supports real assets but does not scream crisis. That aligns with the middle case view. Positioning data supports caution. COT reports show managed money long silver futures, but not at extreme levels. Commercial hedgers have increased shorts modestly, which is normal at higher prices. Banks appear hedged rather than aggressively directional. That's not the setup for an immediate squeeze, but it's also not bearish. So here's my action plan. If silver breaks above 36 on strong volume and lease rates stay elevated, I add modestly to positions. If silver drops below 27, I reduce exposure. Right now, my allocation is roughly 8% physical silver, 3% silver equities, and no leverage. My stop loss on trading positions is 26.50. My take profit zone begins around 38. This is not advice, it's just my framework. What I'm not doing is panic buying because of headlines. I'm not watching fear-driven content on loop. And I'm not assuming this is the end of the monetary system. This week, I'm watching three things. 1, London Vault reports for stabilization or further decline. Bullish if declines slow, bearish if they accelerate. 2, lease rates, specifically whether they stay above 3%. Bullish if persistent, bearish if they collapse. 3, gold's behavior around 2,400. Bullish if it holds, bearish if it fails. Let's wrap this up. Silver inventories are lower but not gone. Lease rates are elevated but not unprecedented. The market is tighter but still functioning. Stay calm, stay data-driven, and don't let urgency override judgment. If this helped you think more clearly, subscribe. This is Financial Briefing. Stay sharp.